What's up, flow traders, lovers? My name is Mike Sharp. This is Sharp Investing, and just right off the bat, this is not investment advice. And anything that happens with your portfolio, that's your problem, not mine. So anyway, I'm just a guy. I do videos on the investments that I hold and buy and sell, and I put them out here for the world to see. And if you have any comments, I would love to hear them in the comment section below. Okay, so let's look at the first quarter or the fourth quarter for flow traders, which was fantastic. You can see here for the year they're up to 369 in EPS, which is way up over 4 times from last year, on a really strong fourth quarter of €1.47. So that was mostly driven by their crypto division, which is also mixed in with fixed income and currency. But this was mostly digital asset based, and they did get some pretty good earnings in Hong Kong as well. Sorry, not Hong Kong, in Asia as well, due to that crazy China pump and dump on the stimulus excitement, and then the deflation afterwards when the market realized it wasn't as great as everybody thought. But the good news for me is those are 2 new areas that they have diversified to in the last few years. And so it shows their diversification plan is really working. They're starting to get earnings from other places. Now the crypto stuff will come and go. It will, it'll spike every once in a while when the enthusiasm in crypto goes up, and when it goes down, it'll go away. So these earnings will be volatile. But the good thing is they did talk a lot about moving capital around to areas that are more lucrative, right? They didn't used to talk about that a few years ago. And now it seems like it's a very high priority for them to move capital where the money is and the action is and the volatility is. So those are really good signs. And maybe this year there'll be action in other places, like in equities. Equities have basically gone straight up for the last 2 years, except for that blip in August, the carry trade blow up in August last year. But other than that, they've just gone up. Interest rates are high, which means that's a headwind for them as well, because they have to pay some interest on their trading capital that they, not the capital they use, but in the trading in their trading process. So if we look at some more stuff here, value traded is up 13% year over year, so that's good. The market continues to grow. I'll show you later how there's some quite good long-term tailwinds here in terms of the industry. Margin is back up to 45%. That's EBITDA margin. The net income margin is lower, but EBITDA is a pretty good gauge of where profit goes, right? Because there's not a huge amount of variability in terms of what comes off of that. But that's also way up from the previous year, over 3 times higher. Last year was actually, I think, their worst year ever in terms of margin, and it was 22%. So that shows you what kind of business this is. This is a very high quality business that churns out cash in almost any market, right? If that's your worst year ever, you're doing something right. And that's since 2014, I think, since they started reporting their results. Okay, you can see that this is the industry ETP value traded. Like they were mostly in ETPs before. They still are, actually. But you can see the volumes spike when there are dislocations, right? Like 2020, that's the COVID spike. That is the start of the bear market in equities. And then it sort of relaxes, right? And now we're just we're getting back to the normal growth of the industry. Not a lot of volatility. You can see by the VIX here, there hasn't been a lot of action except for the start of the Ukraine war. And then if you look down here, same thing, just long-term tailwinds. The interesting thing for me is historically their earnings were really tied to this VIX and the ETP velocity numbers, but you can see now the last quarter, very low velocity, the VIX was muted, and yet the company still did really well. So that's a really good sign. Like I said, the diversification system is working. Fixed income, they said that fixed income was quite muted this period, so they moved capital away from this part of their operation. And that's good. We want them to move it away from stuff that doesn't have any action. But then we look at Bitcoin. Here, this is Bitcoin price versus the volume. And you can see that since the Bitcoin ETFs came online in early 2024, the volumes have been quite good. And actually, the last quarter was even better than that first quarter, which was surprising to me. But you'll see that they're, well, actually, they don't give us enough information to figure out how much of that earnings is coming from the various parts of the business. So we can only guess that, you know, at what percentage is coming from crypto. But you can see that with the decline in volatility, their earnings declined in those quarters as well after quarter one. And this quarter, it's way up. So they may be, their earnings may be even more volatile than they have in past because they're even more tied to crypto. Now, one last thing I want to say about their digital division is that this is basically a free roll, right? I forget how much they put into it, but they bought a few different companies. They did a few deals with some companies in the crypto space, and it only cost them, I don't remember, I want to say 10 million euros or something like that. So if they're churning out massive earnings in this quarter, right? Let's see, what was it? I can't remember. I can't remember the actual income number, but you know, if they're churning out 214 million in EBITDA this year, and let's say maybe half of that's coming from crypto, like that's a 10x return on their original investment, right? So there's, you know, when they first did that, I think I did a video and I said, I don't really know about this. This seems kind of stupid to be in this crypto space. Well, management proved me wrong. They're much more forward looking than I am, and it looks like they're pretty good at finding good deals. So that is encouraging. So let's look at the regional performance. Now you can see here they said in the Americas, mostly the U.S. obviously, they moved capital away from that area as well, right? You can see overall the market was only up 1% year over year, 7%. Sorry, that was for the quarter, and for the year, up 7%. And their volumes were down actually 4%, whereas you can see they had a fairly good quarter in Europe and Asia. Now, one thing I'll mention again, I think I said this in the last video, you can see that Asia's growth is 96%, whereas flow traders is 65%. Europe is 31 and 29 for flow traders. Now, this makes it look like they're losing market share, right? So again, with the year-over-year numbers, it looks even worse. But I think what's happening is they're being more selective about the trades that they're taking and about where the capital is allocated. So they're not necessarily trying to. They actually say they're not focused on this as a metric in terms of, you know, total volume traded in each of the spaces. Their focus is on the bottom line and how they can turn their trades into higher income, right? So if you look over here, you can see that the revenue is actually up 63% and 100% quarter over quarter, right? So they're actually able to turn these small growth in market share, or sorry, in value traded into revenue, which turns into revenue turns into net income quite well. So they're actually, it looks like they're doing quite well in terms of allocating capital to the highest return areas. Let's look at the operating leverage, and you can see that year over year their fixed cost was only up 3%. Now the variable cost is a lot higher because they have a fairly large incentive plan for high trading results, which is actually what we want as owners. We want them to manage the fixed costs and then incentivize people to churn out more income. So that's exactly what they're doing. Now they did say that they are going to invest, which means grow their fixed expenses by about 10% this year to, I think they said 190 to 210 million. So you expect to see this up, but given their history of getting value for their investments, I'm happy for them if they see opportunities that they want to take advantage of. I think that's a good use of capital. They do manage their workforce quite well. You can see there's not much growth here, and again the EBITDA margin 45 this year. That's a bit higher than normal. I think the long-term average is around 40%. So what I'm going to do is I'm going to use that in in my forecast, my 2028 forecast, which I'll do in a minute here once we get through the presentation. So diversification strategy, like I said, going really well. You can see that, especially in the asset class mix, this is the first time they said that they've had a quarter where it's more than 50% in non-equity space, which is a big milestone actually. So now we're not just dependent on European ETPs like we were 2, 3, 4 years ago, right? So this is a really, really good sign to me that their expansion plan, diversification plan is working. Geographical mix, I'd like this to be more North America centric, more heavier on the North America side, because that's where the biggest volumes in the world are by far, but also lower margins in North America. So, long term, I think they're going to have to grow that space, but the actual, I think the area with the biggest potential profit upside is Asia, because those are newer markets where you tend to have less competition for the trades going through. Okay, looking at the structural growth driving market outperformance. So what does that mean? They're basically doing well. You can see he was talking about how the lows are higher than every time they hit a low in terms of net trading income, it grows, right? So they had a low here in 166 million, and then the low was 216, and then last year was 300 million in net trading income. That margin would have been better if interest rates weren't as high, but that was a pretty poor year for profit. But you can see this is one of the only areas you can actually see the growth, because the trading income and the net income are so erratic from quarter to quarter. It's really hard to see the actual growth, but I think this might be an indication. We're getting higher lows and hopefully some higher highs here soon. Even a margin, like I said, at long-term average is about 40%. I expect that to keep up. And hopefully it goes up if they get better at selecting their trades. Capital expansion plan. This is the biggest win here in the quarter for me. Historically, what would happen in a quarter like this, they pay half of the earnings out as a dividend, right? So there'd be almost a 75-cent dividend, but that whole 147 is going to go back into trading capital, and you can see the compounding is really starting to go. So compounding since the end of 2023 to 2024 was 33%. So trading capital is going up by that much, and that is a gauge of how much you can expect your investment to grow. If the valuation stays the same and the margins stay the same long term, like it'll do this, but long term, if they stay the same, then the capital base expansion, that's what we're actually looking for. That's the way we can get a gauge of how much we can expect our investment to grow, right? So since they announced this plan at the end of quarter 2, which is only 6 months ago, it's up 24%. So even if the crypto gains go away for a while and that space relaxes a little bit or even goes down, the capital increase is permanent, right? They're now at 775 million, and this is starting to look quite good. I think their plan is starting to really work. One thing they talked about with the capital expansion plan is they talked about taking on more debt, right? And so he said we have a strategy around acceleration regarding debt, right? So they are actually looking at adding more capital through debt, which is actually what I want. I think I said in the last video, I'm like, just borrow as much as you can, right? If you can borrow at 8%, looks like their debt is about 8%, right? Just based on the $500,000 in interest expense this quarter on 25 million in debt. They didn't report exactly what it is, but just simplistically look at those numbers, it looks like about 8%. If you can pay 8% and then you earn a 24% net margin on that capital, I mean, I would take that deal every single day, right? That's just adding value to the business. So borrow as much as you can. Like I said, they barely ever have losses. I think I've seen one quarter with a small loss. and that's in all different kinds of market conditions, right? So I think the risk there is quite low unless something blows up. So that's basically it for the. Oh, actually, I'll do the mega trends quickly here. So ETP growth. This is the tailwind behind the core of their business, right? Exchange traded products are about 15 trillion right now, and that's about, if they do get to 25 trillion, that's almost 11% compounded by the end of the decade, which is a very nice tailwind to have. And then on top of that, you have, all their execution. If they could add more to that growth rate. This is just the tailwind behind them, right? So, if you have an 11% industry tailwind, that's a pretty good space to be. Electronification. This is mostly in fixed income because a lot of that market has not been digitized. So that's specifically, not specifically, but it's mostly in the fixed income space. Digital assets. This one is totally crazy because he was saying that currently there's about 250 billion tokenized assets in the space, and they're expecting to go to 30 trillion, which is 160% growth rate over the next 5 years, which is totally nuts, right? So if they have an ever increasing foothold in that space, things and we see results like we saw this quarter, things could get parabolic at some point. Again, crypto is pretty volatile. I kind of don't think it's going anywhere now. I was skeptical for a long time, but I think it's starting to gain like an actual real foothold in the finance world, and even with the volatility, it might be here to stay. So they definitely think it is, and these guys are way smarter than me. I'm sure this is one of the brightest management teams that I've come across. So I trust them. Okay, so that's the mega trends. Why don't we go over to a bit of a forecast here, right? So what I'm doing is I'm just taking trading capital. That's what they have right now, 775, and I'm saying, what if they had a 60% margin? Well, that's a 60. That shouldn't be margin. That should be return. Let's see. Return. That would lead to that much net trading income over the year, or that's what it did in 2024. And then the EBITDA margin for the year was 45, EBITDA 215, and then the trading capital increased by 189 million. So that means the ratio of EBITDA to trading capital increase was 88%. This is very simplistic. It's not actually that simple because they're adding debt, and then the taxes change and the expense, some of the non-cash or some of the cash expenses change. It's a little bit more complicated, but for simplicity's sake, I'm just going to take that 88% number and run it through to 2028. And if you remember, they have a 1 billion net trading income goal. That's their medium-term goal. They're trying to get to 1 billion. This year they got 468 million. So in 4 years, if they get the same return on their trading income and get the long-term EBITDA average of 40%, and 88% of that goes to building trading capital, you'll see how fast the trading capital could compound to almost 1.8 billion by the end of 2028, which would mean trading income is getting close to their 1 billion goal, and EBITDA would be about 373 million. Currently, they're about a 6 times EBITDA multiple. If they got that, if we stayed at the same valuation, in 2028, we could see about a 2.2 billion market cap, which would mean an 18% CAGR. Now, if the market got a bit more generous, stopped being as afraid of this company, maybe got to a 10 times multiple on EBITDA, which is not that different from earnings. That's probably more like 13 times earnings. I could be doing the math wrong, but it's not, EBITDA is not that much more than earnings for this company. We could get to 3.7 billion in market cap, which is a 34% CAGR. Now, I think this is quite a good setup, because I don't think there's a huge amount of risk here. They make money in all markets. They do have that very small percentage chance that they could blow up. But on the low end, 18% CAGR, that looks pretty good to me. I think that's it. That's all I'm going to talk about for flow traders. But fantastic quarter. I'm really happy with this, to see that the capital is building so fast. Again, 24% in 6 months is phenomenal. So let's hope that crypto goes to the moon and we can get rich alongside all the gamblers. All right, sorry if you're a crypto gambler. I know it's fun, but I have to say that is dangerous stuff. Anyway, thanks for watching. I hope you got something from that, and I will see you in the next video.